So, as far as federal jurisdiction goes, the federal legislation essentially has different acts in place, which are basically the sets of rules that the financial institutions have to follow. So, this would be your Bank Act, Insurance Companies Act, Trust and Loan Companies Act, Cooperative Credit Associations Act, and the Pension Benefit Standards Act. So, these are all basically the outlines of the rules that the financial institutions have to follow. And so there's three main federal agencies that sort of oversee the financial institutions and make sure that they're following the rules that are in these acts. So these sort of enforce these. So that's your OSFI, FCAC, and CDIC. So the first one here is the Office of the Superintendent of Financial Institutions. So they are in charge of regulating all banks, so Schedule 1, Schedule 2, whatever. And then federally incorporated or registered insurance companies, trust and loan companies, cooperative credit associations, fraternal benefit societies, and pension plans. And then as far as the objectives of the OSFI, there's basically two main ones. So the first one is regulation. And regulation basically just means interpreting the legislation that's set out up here in the acts. And then issuing guidelines for all of the things that are under it. And then it's also approving requests from institution that it regulates. So any of these, if they have a request, then they have to go through the OSFI. And if anybody wants to be federally regulated, then they also have to go through the OSFI. So then the second objective of the OSFI is supervision. So this is anything to do with having enough financial resources to maintain like a sound and feasible institution. So like your bank reserve requirements, bank liquidity, and then also loan loss provisions. So if there's ever like a threat of a failure or anything, they make sure that the banks are prepared for that. And then when there's rules like imposed on the banks, like how no single party can have over a certain amount of shares, that's also monitored by the OSFI. So that's kind of what the supervision is. So then the next sort of main federal agency is the Financial Consumer Agency of Canada, so the FCAC. So they also have two main objectives, and the first one is consumer protection. So that kind of relates to transparency when it comes to, like service charges and fees and borrowing costs and things like that. So this is kind of why you need to always sign documents and everything when you go to the bank. It's all kind of just to cover them. And then the second objective is consumer education. And that basically entails financial knowledge and rights awareness. So if people know their rights. It's essentially, it provides the resources so that people kind of are on the same playing field. So basically, if you want to find things out, you can, and you have the option to. And then the last main federal agency is the CDIC, so the Canadian Deposit Insurance Corporation. So this is that corporation that provides the depositor insurance for up to $100 of coverage per account. So checking account, saving accounts in the event of a bank failure. So this is the one that embeds consumer confidence in the system, and it prevents bank runs and things like that from happening. And then just remember that the CDIC doesn't cover stocks or bonds or anything like that. It only covers deposits, so nothing that fluctuates in value. So then, the main things to remember are that the acts in place, so all of these acts here are the rules to be followed. And then these three main federal agencies, their job is to interpret and enforce the acts. And then the OSFI is to regulate and supervise banks and federally incorporated institutions. And then the objectives of the FCAC are consumer protection and then consumer education. And then CDIC is insurance for deposit accounts. So then, some other financial protection measures in place includes the CIPF, so the Canadian Investor Protection Fund. And this is basically a private trust fund that protects customers from the insolvency of a member. And this relates to securities, so it's sponsored entirely by the SROs. So the coverage for general accounts or trading accounts is $1 million. And that's for losses related to securities and cash balances that result from an insolvency. And then separate accounts, so registered like RSPs and things like that, they're also covered $1 million, so it's $1 million per. But if you have a combined general and separate account, then you just get $1 million coverage, not two. And then if you have joint accounts, then it's proportionate to how much is joint by. So if it's like 50-50 between you and a partner, then each person gets 50% of the coverage. So yeah, this is similar to MFDA in that it only covers in the case of an insolvency. So MFDA covers mutual funds. This does other trading accounts. But it doesn't cover like losses from just general like market activity or whatever. It has to be from the insolvency of a member firm. So yeah, MFDA was already covered in its own right before by itself, but the CIPF just makes it so that coverage includes the IIROC, TSX, Montreal Exchange, Canadian Venture, and Bourse de Montreal. And then yeah, if I remember correctly, the TSX is sort of large corporations, more established, and then Venture Exchange is for startups mostly. So yeah, it's pretty cool. So then another financial protection coverage program is Assurus. So this is basically coverage for insolvent life insurance companies only. And they are a little bit different from CIPF because they don't just kind of give you a payout for your life insurance policy. They basically make it so that whatever you have under the insolvent company just goes to another company that is solvent. So they basically just transfer it over. So yeah, the coverage for Assurus, it depends on what kind of insurance policy you have. And then, yeah, it protects annuities as well. And so, yeah, and then if your insurance company goes insolvent or whatever, you don't have to apply for this. It's just automatically, they just transfer your assets over, so you don't really have to worry. And then another similar organization is PACIC. So that's the Property and Casualty Insurance Compensation Corporation. So the main difference between PACIC and Assurus is life insurance only, and this is like home and auto insurance. And then yeah, it is a requirement for all property and casualty insurers to be members of PACIC. So again, it covers the insolvency of these types of firms. So it's insurance for insurance, essentially. But yeah, it's a little bit different from Assurus because Assurus, when it went insolvent, then it just goes to a solvent company, right? But for PACIC, it's funded by the other members within PACIC. So if a firm goes insolvent, then all the other firms are paying for it, essentially. So then for credit unions, they also have their own little organizations. And these are all provincial. And it works similarly to PACIC, where it's funded by other members that are a part of them. So there's different organizations in each province that kind of do their own thing. And kind of the same objective with all of the other ones. It covers member failure. But yeah, the protection for these guys can range from $100,000 to 100% coverage. It just kind of depends where you are. So yeah, all of these CIPF, Assurus, PACIC, and the credit union organizations, they're all financial protection in the case of insolvency or failure of their firms. CDIC probably could have been in here, but that is more so just for the bigger institutions like banks and things like that. But at the end of the day, it's the same objectives, just different places and different types of products. And then there's another organization for service protection as opposed to financial protection. So this one is called FSON. This is the Financial Services Ombuds Network. So this basically just standardizes how complaints from consumers are handled. So it makes it so that the procedures are all pretty similar. So it sets the precedent of how things are handled, so stereodesis. So basically, if it's done one way somewhere, then it's done the same way somewhere else. And this is related to like the fines for not doing what you're supposed to do in the financial services industry, and just like the confiscation of licenses and things like that. And there's a whole range of groups that participate, but the main ones I'm going to remember are IIROC and MFDA. But it also covers Canadian Bankers Association, Canadian Life and Health Insurance Association, Insurance Bureau of Canada, and Investment Funds Institute of Canada. And yeah, that's regulation. So yeah, just to kind of recap, you have your Constitution Act at the top, and then you have your federal and provincial sides. So you have your provincial commissions that run their own province, and then you have your cooperative organizations where all the provinces work together. So your CSA, Canadian Securities Administrators. And then you have your SROs that operate all across the provinces, so IIROC and MFDA. And then on the federal side, you have your acts in place, so that's like your Bank Act and all the acts that were outlined over here. And then you have your three agencies that basically interpret legislation and enforce it. So that was your OSFI, FCAC, and CDIC. And then you have your financial protection organizations, and that is your CIPF, Assurance, PACIC, and credit unions. So life insurance, property insurance. CIPF was securities. And then the credit unions one, that's different in all the provinces. Just remember, these ones are legislative authority and these ones are not.